there's no money in the ETF. When the money comes into the ETF, it's going to steamroll everything, because the amount of money that's likely to go into that ETF is going to dwarf all of the little traders trying to quote unquote front run that move. So I think the party's just getting started.
2 months ago, a U.S. judge said it was arbitrary and capricious that the SEC allows Bitcoin futures ETF while blocking ETF that hold Bitcoin. The ruling will probably force the SEC to approve spot Bitcoin ETF because its only other option, withdrawing previous approvals of futures ETF, would be even more embarrassing. The SEC defeat has been portrayed as a huge deal for Bitcoin, whose price correlates reasonably well with how often people say Bitcoin. Since August 28, the day before the SEC loss, Bitcoin has added $168 billion in market cap. Bitcoin's 32% gain over the period far exceeds that of gold, plus 3.7%, the Nasdaq Composite, minus 6.5%, and Ether, plus 14.4%, probably on hopes of U.S. regulators becoming friendlier to crypto. So the main driver does appear to be ETF hype. Mark Yusko shares his bullish perspective on Bitcoin and the market psychology, pushing the uptrend for Bitcoin. He further comments that Bitcoin is a people asset and is driven by the masses. Let us now get into the video, and don't forget to hit the like button, subscribe, and drop your comments as you watch.
I think the idea that suddenly people are saying, oh, we're back in a bull market. Well, again, we've been in a bull market for a year. And that chart that you showed, what's so great about it? It's a massive accumulation pattern. Now, there's two types of patterns in markets. There's accumulation and distribution. And accumulation patterns are a series of higher highs and higher lows. It doesn't mean straight up. Markets don't go straight up. They have volatility. They have ebbs and flows, and people get excited and people get afraid, and greed and fear. But when overall there's general accumulation, you make higher highs and then you fall back, but you don't go all the way back to the previous low. You make a higher low, and then there's more accumulation. And the opposite happens in distribution. In distribution, you make a lower lows and lower highs. So it's like a ball bouncing down a set of stairs. That's a bad place. So you look at Netflix chart or even Amazon lately. There's a whole bunch of them that are definitely in a distribution pattern. And I think big tech is about to run into that proverbial wall on that. But Bitcoin is definitely in an accumulation pattern. And the whole idea of front running the ETF, on the margin, see how I did that? On the margin, yes, that is true. But overall, it's impossible, because what I mean by that is, and the reason it's not amazing, the reason it's so great is what the dark blue, the lower chart is human emotion. And what the top chart is the Bitcoin price, which is driven by human emotion. Bitcoin's still young as a market, right? It's not mature like equity. So equities, if you go back and you look at previous bubbles, the 1929 bubble or the 1840s bubble, or when markets were very young and they weren't sophisticated and computerized and the machines didn't run everything, you could overlay this chart. Like if you overlaid the 1929 crash on this chart, it would follow it perfectly, precisely, including the return to normal kind of bounce after the initial drop. And then there's the straight down and the depression, anxiety, denial, all the things, the 5 stages. And if you looked at the 2001, 2002 crash, same thing. 2007, 2008, same thing. But now the equity market isn't human anymore. It's machines. There are no humans. You go to New York Stock Exchange, there are no humans, right? Bitcoin's run by humans. It is mostly individuals. There's a few machines out there trading on the margin, Bitcoin is so human as a market right now. It's why we have something called the Risk Managed Bitcoin Fund. And what it does, it's either in Bitcoin or it's in cash, depending on the trend, like an old-fashioned CTA, commodity trading advisor, and it crushes it. It lags in the up markets. It absolutely destroys it in the down markets. And over the long term, it wins meaningfully. And because that's just market timing. I'm like, yep, exactly. But in human-driven markets, turns out you can market time almost perfectly using simple trend following analysis and a chart like this.
Recent Bitcoin demand looks to be institutional, according to JP Morgan. While attention measures like the Google Trends score have been flatlining since crypto winter, open interest in CME Bitcoin futures contracts, used mostly by institutional investors, has spiked back to levels last seen in August 2022 before the collapse of FTX. JP Morgan also highlights a recent tick higher in on-chain transfers from small wallets to big ones, as shown by the below chart. Bitcoin flow tends to go towards the big wallets when something is positive sounding for institutions to advertise, such as the launch of the first U.S. futures ETF in 2021 and the halving event of 2020, then reverses after stuff blows up. Recent Bitcoin demand, therefore, looks like preparatory work for the ETF marketing blitz. And because buying makes the price go up, it's the preparation that's self-propelling.
People don't pay attention to, I don't think, is the fair value follows this Metcalfe's law model. We've had Tim on the show and he talks about it.
Get Tim back on.
It has little fluctuations when things happen, like, China bans mining and the hash rate declines. Well, yeah, that's going to have an impact on the network. Guess what? And then it comes roaring back. And now we're at new all-time highs in hash rate. And you'll have people flee and you get a bunch of wallets that disappear, but then they slowly come back. And now we have more wallets than ever before. And so the fundamentals follow this Metcalfe's law model. So, but the price isn't the value, right? We talk about this over and over in every asset. Price is a liar. Price is simply what you and I or two other people decide to exchange a small value of a good or service. That's the price. That's not the value. Right? The value of anything could be higher or lower. Right? That's when stocks are undervalued or overvalued, or bonds are undervalued or overvalued. Bubbles form. Right? There was a great. We do our weekly webinars, and we did the hedge with capital D yesterday, and Corey, one of my partners, had this great chart of the two big bubbles, the Japan bubble and the US stock bubble and the bond bubble. And they declined the same amount. It's like, well, that wasn't a bubble. Like, long bonds were in one of the greatest bubbles of all time because we took interest rates all the way to zero for 13 years. And everybody bought them. The banks bought them, everybody bought them, and the price got stupid and the yields got stupid. And now that's changed. And TLT's down 50 some odd percent, fell the same amount as the Japanese stock market or the US stock market in 2007, 2008, global financial crisis. So bubbles pop. But the thing about Bitcoin is when it's below fair value, as it is today, it will drift. And what I say is fair value, again, according to Tim's model, about 50K. It's like 52, 53, but I'm going to just round it to 50. And we're going to drift toward that number because we're out of spring. We're in summer, June to, June of next year. Then the halving occurs. Then we're going to go into fall. Now, what's fall? Well, fall is where people start to pay attention because the halving happens. And now the fair value actually goes up because now the price has to adjust to reflect the fact that the miners are getting less rewards. And he says, well, why does that have to happen? I'm like, well, it's just built into the code. And I think it's one of the mad genius things about the code is that you build in this mechanism that forces an increase in price because rising prices attract attention. And so then you get the movement, and we'll get back to fair value. And think about it, fair value will now be 100. Okay. Now we're going to drift back to fair value. Well, then what happens? it went from 34 to 100. Oh my God, I got to get in. And you have the FOMO, and then you get the parabolic move. And then we get above fair value, which sows the seeds of demise that you have to have another crash. And so this boom bust period.
Cycle of life, baby.
Cycles. And it's shorter than the norm. Like stocks have done this for 200 years. It's an 11-year cycle. And we messed it up with the QE era. But if you go back and you look at history, there's this 11-year cycle of the economic cycle and the business cycle and the Fed liquidity cycle. It's not rocket science. It's not voodoo. It's real. And the cycle in Bitcoin is shorter because it was put into the code. And and then humans are reacting to the code, and humans get super fearful, right, at the bottom, and they get super greedy at the top.
The SEC has until January 10 to respond to a joint application from ARK Invest and 21 Shares, though no one in the industry seems to expect it to take that long. Grayscale and BlackRock have made formal registrations to launch spot ETF, and here's a flow of filings amendments indicating back and forth between the regulator and asset managers to work out who can hold what. It's likely, says JP Morgan, that the SEC will issue mass approval notices to avoid gifting any manager a first-mover advantage. The main benefit of a spot ETF is that it's a more direct form of ownership than a synthetic fund, whose reliance on derivatives can introduce lag and hedging risk. A cleaner structure is nice, but to any prospective buyer of a Bitcoin ETF, it might not matter all that much. No one buys crypto for its simplicity. Nikolaos Panagurtsoglu of JP Morgan's Global Markets Strategy team has called the spot advantage rather marginal and unlikely to be a game changer for crypto markets. We're being told a lot that US-listed spot Bitcoin ETF will be revolutionary for institutional ownership of crypto. Going by the historical demand, they probably won't even be revolutionary for ETF providers. Chances are that by next year, it'll all be forgotten, by which time there will be another Bitcoin halving event to look forward to. Peter Schiff recently remarked that a final SEC approval will end Bitcoin's spot ETF rally. The Europac chief says once Bitcoin is approved for a spot ETF product, the rally will lose steam. He had also noted the possibility that cryptocurrency traders could begin to sell off and take profits before any forthcoming SEC approval. In an X post on the popular social media website formerly known as Twitter, Schiff wrote, Bitcoin is now trading at $35,000 as speculators bet on SEC approval of GBTC converting into an ETFs. Such a conversation will likely mark the top of the rally if Bitcoin doesn't sell off before approval. The sell-off will be less severe if the ETF conversion is rejected again. Time will tell if he's right. Bitcoin price went parabolic in the 48 hours after Schiff tweeted this. Do you think the ETF would be worth the hype, or is this just hopium? Let us know in the comment section below. Also, don't forget to hit the like button, subscribe, and turn on notifications. Thanks for watching.